All right, welcome back to The Explainer. Today, we are diving straight into something absolutely wild. We're bridging high-minded physics with hardcore Wall Street finance. We're going to look at a fascinating breakdown of how strategy, trading as MSTR, has built this synthetic capital architecture that is fundamentally changing how we look at digital assets. We are literally cracking the code on what some people are calling space money. And then we're going to analyze a real-world portfolio audit to see if this theory actually holds up in practice. So, before we even think about traditional financial metrics or yield curves, we've got to completely reframe how we view the asset itself. Think about gold for a second. It constantly inflates as we pull more of it out of the ground, right? It's not truly finite. But what happens when you treat a strictly finite digital asset like Bitcoin not just as some speculative tech stock, but as raw thermodynamic energy? Well, it shifts the entire conversation. We move away from narrative-driven hype and straight into the hard, unyielding laws of physics. Take a look at this number, 3,353. And no, that's not a dollar amount or a price target. That represents the raw gigajoules of energy required to mine a single Bitcoin after the latest halving cycle. When we actually calculate the public network hash rate, the median ASIC efficiency, and the new supply issuance, what we see is an incredible physical expenditure. It is essentially stored thermodynamic work. When you establish this thermodynamic work, you're creating a literal physical cost of production floor measured in joules per BTC. It frames the asset quite literally as space money. And this framework proves something incredibly important. Terminal value is bounded below by the unforgiving physical laws of energy production. This provides a massive, measurable anchor against pure speculative hype. Just to put that massive thermodynamic reality into perspective, because it's kind of hard to wrap your head around, producing one single newly minted Bitcoin commands the equivalent electricity of a typical American home running for 89 years. Literally almost a century of household electricity packed into one digital coin. It's this incredibly dense, volatile energy that really sets the stage for the sophisticated financial engineering we're about to explore. Section 1. Cracking the crypto reactor. Distilling digital credit from volatility. Michael Saylor actually hit the nail on the head here when he said, digital credit will help drive the digital railroads. It is the kerosene of finance. Strategy's corporate treasury is essentially synthesizing a completely new foundational asset class. They're taking raw, volatile digital capital and refining it so that traditional finance platforms can easily digest and distribute it. The math behind this asset distillation process is just fascinating. You start with raw Bitcoin, which is this highly energetic, untamed asset sitting at about 40 volatility and a 40% annualized return. What Strategy does is strip out the currency and duration risk. They distill that raw energy into digital credit, like STRC and the related preferreds, think STRK, STRF, and STRD. These boast a super stable volatility of around 3 with an 11.5% yield. Then, on the complete opposite end of the spectrum, they create amplified equity, their MSTR common stock, running at a massive 71 volatility and a 59% annualized return, specifically designed to aggressively outpace benchmarks like the S&P 500. Check this out. 2.27%. That is Strategy's break-even annualized return on Bitcoin. The math here is stunning. If the underlying asset grows by just 2.27% annually, the company can fund their digital credit dividends in perpetuity without ever having to sell a single share. Honestly, even if growth stays completely flat at 0% forever, they still have enough runway to fund dividends for 43 years. Section 2. Reality check. The Terminal Sovereignty Audit. So, when we pull back the curtain and examine an actual, real-world user portfolio aiming to capture this exact energy, we immediately spot an illusion. The user totally believed they had a broadly allocated, diverse macro estate. But what looks diverse on the surface is actually massively concentrated. A staggering 60% of the entire portfolio is tied up in correlated vehicles across various layers of abstraction. The hidden reality of all this concentration is a massive 0.79 beta. What does that mean for you? It means for every 1% the underlying asset moves, this portfolio is wildly swinging nearly 0.8%. It's literally 2.3 times as volatile as the S&P 500. But this massive exposure is totally masked by complex derivatives, leaving the investor completely vulnerable to a brutal 53% account drawdown. And with a low Sharpe ratio, which basically means you're getting terrible returns for the massive amount of risk you're taking, they are vastly underperforming a much simpler, balanced approach. And compounding that risk is this severe position fragmentation. I mean, look at this. This specific capital architecture suffers from total bloat, with over 100 micropositions sitting under $25. These tiny holdings eat up massive amounts of cognitive bandwidth. I mean, they're tracking nearly 200 line items, while contributing absolutely nothing to the portfolio's actual alpha. But here is the most dangerous trap revealed in the audit. It's the synthetic yield engine of covered call ETFs. While pure spot exposure was down 13.8% over the specific historical window, the yield ETFs were mathematically devastated. Tickers like YBIT, XPTY, and MSTY were down anywhere from 52% to nearly 78%. They literally bleed out via severe net asset value erosion compared to just holding the pure asset. Understanding the structural risks of synthetic yield is absolutely crucial here. I mean, sure, a 17% dashboard yield sounds amazing on paper, right? But it masks some severe structural drags. You've got issuer risk, like the dilution from the company issuing more preferreds like STRK and STRF to fund their Bitcoin stack. Then there's call cap drag, where you're just totally missing out on massive spot market bull runs. You suffer mathematical erosion in choppy markets, and ultimately, that high payout is often just a phantom yield. It's really just a return of your own rapidly eroding principal. Section 3. Optimization. Reallocating for true alpha. So how do we fix this structural rot? We mathematically optimize the architecture to truly outpace the market. Step 1, we trim the open stock position by 50% to lock in massive tax-free gains. Step 2, cap those STRC preferred shares at 25% to manage that issuer dilution risk. Step 3, liquidate those decaying yield ETFs entirely to stop the bleeding once and for all. And step 4, rotate that recovered capital strictly into pure spot and direct miner exposure. What you get is this rebuilt, incredibly clean, focused trio. Let's say $5,000 in pure spot exposure with absolutely no upside cap, $3,000 in direct common stock to capture that amplified thesis via the corporate treasury, and $1,000 in best-in-class operational miners. By doing this, you capture the exact same synthetic beta you had before, but you strip away the friction, you strip away the fees, and you completely eliminate those capped ceilings. So this brings us to the ultimate question. Is your portfolio engineered to capture true cosmic alpha, or is it quietly bleeding out in synthetic yield traps? Take a forensic look at your own capital architecture today. Decide if you are ready to stop bleeding yield and finally harness the true thermodynamic potential of your assets. Thanks for joining me on this explainer, and keep questioning your structural assumptions.